Something is changing in the silver market. Not tomorrow, not next month. Right now, at this very moment, the fundamental conditions that govern silver's price are shifting in ways we haven't seen in years. For those paying attention, the signals are unmistakable. For those who aren't, the opportunity may pass before they even realize it existed. This isn't about chasing quick profits or gambling on price predictions. This is about understanding what's actually happening beneath the surface of one of the most misunderstood markets in finance. Silver has always occupied a unique position in the global economy, part industrial commodity, part monetary metal, part safe haven asset. This hybrid nature makes it more volatile than gold, more sensitive to economic cycles, and capable of explosive moves that catch most investors completely off guard. Today, we're going to examine why silver may be approaching one of those rare inflection points. We'll look at the technical setup, the fundamental drivers, the macroeconomic backdrop, and most importantly, what you should actually do about it. Whether you already hold silver or you're considering your first position, the decisions you make in the coming weeks could define your financial position for years to come. But let me be clear from the start. This conversation is not about certainty. Markets never offer certainty. What they offer is probability, context, and opportunity for those prepared to act with discipline and emotional control. My role today is not to tell you what silver will do. It's to help you understand what it could do, why it could do it, and how to position yourself intelligently regardless of the outcome. The question isn't whether you believe in silver. The question is whether you understand what's happening and what you're going to do about it. Let's begin. To understand where silver might be going, we first need to understand where it is right now. Silver has spent much of the past few years in a consolidation pattern. After the explosive rally during the pandemic, when it briefly touched $30 per ounce, the metal retreated and has been building a base. This isn't unusual. In fact, it's exactly what healthy markets do after major moves. They consolidate, they digest gains, they build energy for the next leg. What makes the current moment different is the confluence of factors now aligning. These don't happen in isolation. They're interconnected, each one reinforcing the others, creating conditions where a relatively small catalyst could trigger outsized movements. Consider the technical picture first. Silver has been testing key resistance levels repeatedly over the past several months. Each test weakens that resistance. Think of it like a dam under pressure. Every wave that crashes against it erodes the structure slightly. Eventually, when enough pressure builds and enough erosion occurs, the dam doesn't just crack, it breaks catastrophically. The same principle applies to resistance levels in trading. We've seen silver approach and retreat from critical price levels multiple times. But with each approach, the selling pressure diminishes. Fewer sellers appear, more buyers hold their ground. The balance of power shifts incrementally until suddenly it shifts completely. Now, look at the broader precious metals complex. Gold has been making new all-time highs. Platinum has shown renewed strength. Even palladium, despite its unique supply-demand dynamics, has stabilized after a difficult period. When an entire sector begins to move, the laggards often catch up violently. Silver, historically, has been that laggard. It underperforms during the early stages of precious metals rallies, then dramatically outperforms once momentum builds. Why does this happen? Because silver is smaller, more volatile, and more speculative than gold. When uncertainty first emerges, institutional money flows to gold, the traditional safe haven. But as confidence builds and investors become convinced the move is real, they shift toward higher beta assets that offer greater percentage returns. That's when silver catches fire. We may be approaching that transition point right now. Let's move beyond charts and discuss the fundamental forces driving this market. Silver's dual nature, both industrial metal and monetary asset, makes it uniquely responsive to multiple economic narratives simultaneously. This is both a blessing and a curse. It creates complexity, but also opportunity. On the industrial side, demand is accelerating. Solar panel production continues to expand globally as nations pursue renewable energy mandates. Electric vehicles, while often discussed in terms of lithium and copper, also require significant silver for electrical components. The technological transformation of the global economy is inherently silver intensive. But here's what most analysis misses. Industrial demand creates a floor, not a ceiling. Industries need silver regardless of price. They'll pay what they must to secure supply. This creates inelastic demand, the kind that supports prices during weakness and amplifies moves during strength. The monetary aspect is equally important. Central banks around the world continue to hold interest rates at levels that, historically, have been considered accommodative. Real interest rates, nominal rates minus inflation, remain negative or barely positive in many developed economies. This environment has always been favorable for precious metals because it reduces the opportunity cost of holding non-yielding assets. Think about it logically. If you can earn 5% in a savings account while inflation runs at 2%, you're gaining real purchasing power by simply holding cash. But if you're earning 3% while inflation runs at 4%, you're losing ground every single day. In that environment, tangible assets become increasingly attractive. We're still living in that second scenario, despite central bank attempts to normalize policy. And markets are beginning to recognize that the normalization process has limits. Governments carry unprecedented debt loads. Raising rates too high for too long would trigger fiscal crises. This constraint on monetary policy creates a ceiling on real rates and a floor under precious metals. Now add geopolitical complexity to the equation. Trade tensions, regional conflicts, currency volatility, declining trust in traditional reserve currencies. Each of these factors individually might be manageable, but together they create an environment where diversification into tangible assets makes rational sense. Silver benefits from all of this, but with an additional twist. Unlike gold, which exists primarily in vault storage, silver gets consumed. It's used in industrial processes where recovery is either impossible or economically impractical. This means that despite millennia of mining, above-ground silver inventories relative to annual production are actually quite modest. When you combine growing industrial consumption with investment demand from those seeking monetary protection, you create a supply-demand dynamic that can become very tight very quickly. We saw this in 2010 and 2011. We saw it again in 2020, and we may be approaching another such moment. The inventories on major exchanges have been declining. Mining production, after years of underinvestment, struggles to grow meaningfully. Recycling helps, but it can't fill the gap entirely. Meanwhile, both industrial and investment demand continue to climb. What happens when an inelastic demand curve intersects with an inelastic supply curve? The price must adjust. And because silver is a relatively small market compared to stocks, bonds, or even gold, the adjustment can be swift and severe. Markets don't move based on fundamentals alone. They move based on perception, emotion, and the collective decisions of millions of participants. Understanding market psychology is just as important as understanding supply and demand. Right now, sentiment towards silver remains mixed. This is actually bullish. Let me explain why. When everyone is excited about an asset, when mainstream media covers it constantly, when your neighbors ask you about it at dinner parties, that's when you should be cautious. Euphoria marks tops, not bottoms. The best opportunities emerge when an asset is ignored, misunderstood, or dismissed by the majority. Silver currently occupies that space. It's not front-page news. It's not trending on social media. Retail enthusiasm is muted compared to cryptocurrencies, tech stocks, or other more fashionable investments. This absence of excitement is precisely what makes the setup interesting. Institutional positioning tells a similar story. Large speculators in futures markets are not excessively long. Commercial hedgers maintain their typical short positions, but not at extreme levels. This balanced positioning means there's room for new buying to enter without immediately encountering profit-taking from overcrowded positions. Contrast this with situations where everyone is already fully invested. In those cases, who's left to buy? When the last buyer purchases, price must decline because only sellers remain. But when positioning is moderate and sentiment is cautious, new catalysts can attract fresh capital and drive sustained moves. The timing question is always difficult. Markets can remain irrational longer than you can remain solvent, as the saying goes. A good setup doesn't guarantee immediate results, but probabilities matter over time. When the technical setup, fundamental drivers, and psychological backdrop all align, the probability of a significant move increases substantially. We can't know exactly when that move will begin. It could be today, next week, or next month, but we can know that the ingredients are assembled. We can know that historically, when these ingredients come together, explosive moves have followed, and we can prepare ourselves to act rationally when the moment arrives. This is where most investors fail. They wait for perfect certainty, which never comes, or they act impulsively based on emotion rather than strategy. The skilled investor does neither. They assess probability, position accordingly, and maintain discipline regardless of short-term volatility. Think of it like weather forecasting. Meteorologists can tell you that conditions are favorable for a storm, warm water temperatures, low pressure systems, wind patterns. They can't tell you the exact moment the storm will form or the precise path it will take. But knowing that storm conditions exist allows you to prepare. You secure your property. You adjust your plans. You don't wait until the hurricane is overhead to start thinking about what to do. Market opportunities work the same way. The signs are there for those trained to read them. The question is whether you're prepared to act when the opportunity materializes. History doesn't repeat, but it often rhymes. Looking at previous silver cycles provides valuable context for what might lie ahead. Go back to 2010 and 2011. Silver began that period around $17 per ounce. Within 18 months, it had nearly tripled to just under $50. What drove that move? A combination of factors, remarkably similar to today: loose monetary policy following the financial crisis, concerns about currency debasement, growing industrial demand, and critically, a shift in investor sentiment from caution to conviction. The move wasn't linear. There were violent pullbacks along the way. Anyone who panicked during those corrections missed the bulk of the gains, but those who understood the bigger picture and maintained their positions through volatility were rewarded handsomely. Then came the correction. Silver fell from its 2011 peak and spent the next several years in a brutal bear market, eventually bottoming near $14 in 2015. Many declared silver dead. Investors who bought near the top swore they'd never touch precious metals again. This emotional scarring kept many on the sidelines during the next cycle. The pandemic brought another surge. From March 2020 to August 2020, silver roughly doubled from $15 to nearly $30. Again, the pattern held. Initial skepticism gave way to momentum. Momentum attracted new buyers, and the move accelerated into a crescendo. What can we learn from these cycles? First, silver moves in long periods of consolidation, punctuated by brief, explosive rallies. You can wait years for these moments, then see 12 months of gains compressed into 12 weeks. If you're not positioned before the move begins, you'll spend the entire rally trying to catch up. Second, the best entry points feel uncomfortable. In March 2020, with global markets in freefall and economic apocalypse seemingly imminent, buying anything felt insane, yet that fear marked the perfect entry point. In 2010, after years of poor performance, most investors had moved on from precious metals entirely. Again, perfect timing. Third, the moves always go further than rational analysis suggests they should. This isn't because markets are irrational, though they sometimes are. It's because human emotion amplifies technical moves. Fear and greed create overshoots in both directions. Trying to call exact tops and bottoms is a fool's errand. The goal is to capture the middle portion of major trends, nothing more. Right now, we're potentially setting up for another one of these cyclical surges. The consolidation phase has lasted several years. The fundamental backdrop is supportive. Technical patterns are maturing. And most importantly, sentiment hasn't turned euphoric yet, which means the move, if it comes, likely has room to run. This doesn't mean it will happen. Markets always retain the right to surprise us, but the pattern, the context, the setup, they're all consistent with previous inflection points, and that's worth paying attention to. If you already hold silver, your strategic position is very different from someone considering an initial purchase. Let's talk about what you should be thinking about right now. First, resist the temptation to overthink your position. If you bought silver as a long-term hedge against monetary instability or as a portfolio diversifier, nothing about the current setup should change that thesis. Don't let short-term price movements distract you from your original strategic intent. That said, if you've been holding silver through years of consolidation and you're now seeing the possibility of a significant move, this is a moment for reflection. Ask yourself, what's my exit strategy? Do I even have one? Many investors buy with clear conviction, but never define under what circumstances they'd sell. This creates emotional paralysis during volatile moves. Consider implementing a tiered approach. Perhaps you view a portion of your holdings as permanent insurance, something you maintain regardless of price movements, but another portion might be tactical, intended to capture cyclical moves. If that's the case, defining specific conditions under which you'd take profits removes emotion from future decisions. For example, you might decide that if silver doubles from current levels, you'll sell 25% of your tactical position and let the rest run. Or you might use technical levels, selling into strength when the market becomes overextended. The specific strategy matters less than having one at all. Another consideration: are you properly diversified within your precious metals allocation? Some investors hold only silver, attracted by its higher volatility and potential for larger percentage gains. But this concentration adds risk. Having exposure to both gold and silver often makes sense. Gold provides stability, silver provides upside. The combination creates a more balanced precious metals position. Also, think about the form of your holdings. Physical metal offers security and eliminates counterparty risk, but it's less liquid and comes with storage considerations. Exchange-traded products provide liquidity and convenience, but introduce different risks. Mining stocks offer leverage to metal prices, but add equity market exposure and company-specific risks. There's no perfect answer. The right mix depends on your specific situation, but it's worth reviewing whether your current allocation still matches your objectives. Above all, avoid the trap of becoming complacent. Just because you bought years ago doesn't mean you can ignore the position now. Markets change, conditions evolve, your financial situation may have shifted. Regular review doesn't mean constant trading. It means maintaining awareness and ensuring your positions still serve their intended purpose. If this breakout materializes and you're fortunate enough to have been positioned ahead of it, remember that what goes up can come down just as quickly. Have a plan for managing gains. Have a plan for weathering pullbacks. And most importantly, don't let a winning position turn into a losing one because you became attached to the story rather than focused on the reality. If you don't currently hold silver but you're intrigued by the potential opportunity, your considerations are entirely different. Let's work through them methodically. First question: Why are you considering silver now? If the answer is because someone said it's about to explode, that's not good enough. You need to understand the investment case yourself. You need to know what you're buying, why you're buying it, and under what conditions you'd be wrong. Take the time to educate yourself on silver's role in the economy, its historical price patterns, and its correlation with other assets. Understanding what you own dramatically improves your ability to hold through inevitable volatility. Investors who don't understand their positions panic at the first sign of trouble. Those who do can maintain discipline. Second question, how much should you allocate? This depends entirely on your overall portfolio, your risk tolerance, your time horizon, and your financial goals. But here's a general principle. Never put so much into any single position that its failure would materially harm your financial security. Silver is volatile. It can fall 30% in a matter of weeks. If that would keep you up at night or force you to sell at the worst moment, your position is too large. Many financial advisors suggest precious metals should represent somewhere between 5 and 15% of a diversified portfolio. Within that allocation, silver might represent a portion, with gold comprising the balance. These aren't rules, they're guidelines. Your situation may call for more or less, but the principle holds. Size positions based on risk management, not on how excited you are about the opportunity. Third question, how should you enter? If you believe a significant move is imminent, you might be tempted to buy everything at once. This can work, but it also maximizes your regret if the market pulls back before rallying. Consider a staged entry, buying in tranches over several weeks or months. This sacrifices some upside if the move begins immediately, but it provides psychological protection and often results in a better average entry price. An alternative approach. Establish a core position now, but keep some capital in reserve for opportunistic additions if the market provides better prices. This gives you immediate exposure to a potential breakout while maintaining flexibility to improve your position if volatility creates opportunities. Fourth question, physical metal or paper exposure? Physical silver, coins, or bars offers tangible ownership and eliminates counterparty risk. You hold the actual asset. The downside is storage, security, and liquidity considerations. Selling physical silver quickly at fair prices can be challenging. Exchange-traded products provide liquidity and convenience. You can buy and sell with a single click, just like a stock. The downside is you're trusting the fund structure and the custodian. You don't own physical metal. You own a financial claim on metal. Mining stocks offer leverage to silver prices. When silver rises, well-managed mining companies often rise further in percentage terms, but they also introduce operational risk, management risk, and correlation with the broader equity market. During market crashes, mining stocks can fall regardless of metal prices. There's no perfect answer. Many investors use a combination, some physical for security and peace of mind, some ETF exposure for tactical trading, perhaps some mining stocks for leverage if they understand and accept the added complexity. The key is to match your implementation to your objectives. If you're buying as long-term insurance, physical probably makes sense. If you're making a tactical bet on a near-term price move, ETFs might be more practical. If you're comfortable analyzing individual companies and want maximum leverage, miners could fit, but know what you're doing and why. Finally, remember that timing is impossible to perfect. You might buy today and watch the market drift lower for months, or you might wait for a better entry and watch prices gap higher, leaving you behind. There's always a chance you'll feel foolish in the short term. Accept this as the cost of participation. What matters is whether your position makes sense over a meaningful time frame, not whether you nailed the exact bottom tick. Now let's discuss what not to do. These are the behavioral mistakes that destroy returns and create unnecessary stress. Pay attention to these warnings. They matter more than anything else I've said today. Silver's volatility makes leverage extremely dangerous. Yes, using margin or options can amplify gains if the move materializes quickly. It can also wipe you out completely if the market moves against you first. Even if you're ultimately right about direction, leverage can force you out of the position before you're proven correct. Stay within your means. Use only capital you can afford to hold through volatility. If silver gaps higher tomorrow and continues rallying, your first instinct might be to jump in immediately, fearful of missing out. This is precisely when you need discipline. Parabolic moves always pull back, always. If you chase strength, you'll likely buy near a short-term peak and then suffer through an immediate drawdown. Either establish positions before the move or wait patiently for the inevitable consolidation that follows the initial surge. Fear and greed are the enemies of good decision-making. When silver falls, fear will tell you to sell before it goes to zero. When silver rallies, greed will tell you to buy more even though you're overextended. Neither emotion produces good outcomes. Have a strategy. Follow your strategy. Ignore your emotions. Every investment should have a framework for managing risk. This might be a stop-loss level, maximum position size, or a predetermined time frame for review. Whatever system you use, have one. Hope is not a strategy. Wishful thinking is not a plan. Know in advance what you'll do if things go wrong. If the fundamental picture changes, be willing to reassess your position. Maybe central banks shift policy more aggressively than expected. Maybe industrial demand disappoints. Maybe geopolitical tensions ease. Whatever the case, stay flexible. Conviction means you've done your homework and you believe in your thesis. Stubbornness means you refuse to acknowledge when conditions change. One is valuable, the other is destructive. Silver, regardless of how compelling the setup, remains a small piece of a comprehensive financial plan. Don't let a single investment, no matter how excited you are about it, distort your overall allocation. Maintain diversification. Continue contributing to retirement accounts. Keep an emergency fund. All the boring, responsible financial habits still matter. When you're excited about an investment, the natural temptation is to talk about it. Resist this urge. Sharing your positions creates social pressure that can interfere with good decision-making. If you tell everyone you know that you're buying silver, you'll feel foolish if it drops, making you more likely to panic sell. And you'll feel vindicated if it rallies, making you more likely to hold too long. Arguing with skeptics is even worse. You'll waste emotional energy defending your position, which only strengthens your attachment to it and reduces your objectivity. Make your decisions quietly, act on them privately, let results speak for themselves. We've covered a tremendous amount of ground today. Let's bring it all together. Silver may be approaching a significant inflection point. The technical setup, fundamental drivers, and a historical context all suggest the possibility of a substantial move in the near term. This doesn't mean such a move is certain. Nothing ever is in financial markets. But the probability has increased to a level worth taking seriously. For those already holding silver, this is a moment to review your strategy and ensure you're prepared for either direction. Have a plan for managing volatility. Know under what conditions you take profits or add to positions, and resist the urge to overcomplicate what should be a straightforward long-term holding. For those considering new positions, understand what you're buying and why. Size your position appropriately. Enter with a strategy rather than hope. And remember that the goal isn't to catch the exact bottom, it's to participate in the meaningful middle portion of a potential trend. Regardless of which group you fall into, the principles remain the same. Discipline matters more than cleverness. Risk management matters more than profit maximization. Emotional control matters more than perfect timing. These aren't exciting truths, but they're the truths that separate successful investors from everyone else. The coming weeks and months will reveal whether this setup materializes into the significant move that the conditions suggest is possible. You can't control that outcome, but you can control how you prepare for it, how you respond to it, and how you manage yourself through it. What separates the investor who thrives from the one who struggles isn't access to information or intelligence or even luck. It's the ability to act rationally when conditions are uncertain and to maintain discipline when emotions run high. That's what I hope you take from this conversation today. Not a price target, not a guarantee, not a promise of easy wealth, but rather an understanding of what's happening, why it matters, and how to think about it clearly. The decisions you make from here are yours alone, but make them based on strategy, not emotion. Make them based on your specific circumstances, not on what everyone else is doing, and make them with the understanding that the only certainty in markets is uncertainty itself. Silver has always been a volatile emotional market. It rewards patience and punishes impatience. It favors those who think in years, not days. And it has a long history of explosive moves that seem obvious in retrospect, but terrifying in real time. We may be entering another such period, or we may not. But either way, the principles we've discussed today apply. Stay disciplined. Stay rational. Stay focused on what you can control. And remember that the goal isn't to predict the future. It's to prepare for multiple possible futures and position yourself to benefit regardless of which one unfolds. That's how you build lasting wealth. Not through lucky bets or perfect timing, but through consistent application of sound principles over long periods. The opportunity in silver, if it materializes, is just one opportunity among many you'll encounter in your investing lifetime. Approach it with respect, not with recklessness, with strategy, not with speculation. And above all, remember this: markets will always offer another opportunity, but you only get one financial future. Protect it, nurture it, build it thoughtfully. That's the real lesson here today. Thank you for your time and attention. Stay disciplined, stay prepared, and I'll see you in the next video.